Hi, this is Josh Weidman. I wanted to welcome you to today's REI 360 training. Today what we're going to talk about is how to evaluate and identify the types of rental properties that you want to invest in. It's a topic that I get a lot in my property management company. We get people that come to us all the time with upside down portfolios, with properties that are really just a mess, and they wonder why. And the truth is, there's no more true statement in real estate that you make money when you buy, not when you sell. Well, we're going to look at two types of buy and hold investments and two strategies and kind of see what fits your model as an investor and see how they apply. So the first thing that we're going to look at is the motivation. There's two motivations. Motivation number one is cash flow. A lot of people like rental properties because they like an extra paycheck every month. This could be anywhere from $50 or $60 to several hundred or several $1,000s depending on the size of the property. This is the kind of thing that you want to target if you're looking to pay a bill or you really want to get out of that 9-to-5 job and you want to start investing full time. You need a consistent income coming in each month. And it's the kind of thing that you're looking, as I said, income, but also immediate profits. So that's cash flow investments, and we'll get into some more details there in a minute. But then on the flip side of that, almost the absolute polar opposite direction, you have wealth building. And wealth building, you're looking at building equity and appreciation in a piece of real estate. That's the focus. It's not so much on the cash flow of the property. Obviously, it's something you have to consider unless you're just paying cash for the property to begin with. But wealth building is the kind of thing where you're going to be cashing out when you refinance the property several years from now or when you resell the property several years from now. So these are two separate and opposite ends of the buy and hold spectrum. I have a graph up here that kind of gives a little bit of an explanation specifically on the cash flow end of things. On the bottom here we have property values, and as property values increase, this graph is showing property values to cash flow. Typically speaking, the more cash flow you get on a property, lower the property value. And that's pretty simple. If you're paying less for a property and you're able to rent it for a decent amount, you're going to get more cash flow than if you're paying a ton of money for a property that's probably not going to give you the cash flow and the money that you need. But what goes with this profit, that's the green line, this profit line, is your time and management. Properties with the most cash flow are typically in little dicier areas of a community. They're going to attract a tenant who is typically going to demand a lot more attention, and the properties are typically going to demand a lot more attention and upkeep. So it's going to have a lot more demand on your time. So while you might be making a larger profit on a cash flow basis, it's going to impact how attractive this kind of investment is, depending on how much time you want to put into it and management you want to put into it. So let's take a look at one thing that I try to look at it is I want to try to find the center. I want to find an area where I can get a good amount of cash flow on the property, but also limit the amount of time I have to invest in it and have a pretty decent value. So if I can get a good deal right in this center area here, where yes, I'm going to have to invest a little bit of time. Yes, I'm going to have to pay a little bit more for a property, but I'm going to get the cash flow I need, and I'm going to have a little bit more of a consistent property value. So if we look at cash flow investments, this is the target area that I'm looking for. These areas are typified by being tenant occupied between 30 and 70% of the market. So between 3 and 7 out of 10 people, residents, are tenants. It's a pretty high percentage. You have a large range of sale values. These are the types of areas that you can go in and you might see a property that's selling for $130,000 and also one that's selling for $25,000. There's a huge divergence there. This is a great opportunity to go in and grab some deals, grab some value there, but it's one of the characteristics of the area. When you're doing your evaluation on cash flow investments, you're not worried about the property value. Very little plays into your decision making. It's all based on rental income. When I do my evaluation of these properties, I'm evaluating, I'm looking at the rental rates, and I'm also looking at my repair costs. When I'm considering my repair costs, one thing that I want to keep in mind is that I want to put the property, after I buy it and rehab the property, I want it to be in a situation where there will be no major repairs within the next 10 years. Well, what's that mean? Well, I got a new roof, the windows are updated, the kitchens and bathrooms are in decent shape. You know, I'm not going to have to do any major repairs on that end. The heating system is updated. The electrical system, updated. All of the major systems, the things that cost a lot of money, are all taken care of right up front with my construction, so that when I move a resident in there, it might not be the prettiest place in the world, but it sure is structurally sound. When they go and they flick the heat on in the middle of winter time, that heater's going to kick on without a problem. I'm not going to have a leaky toilet that's going to, you know, flood the ceiling on the first floor when it's leaking on the second floor. All of the mechanicals are sound, and you know, the property is in good physical shape. One thing that you should expect, and I mention this because a lot of people will, when they're doing their evaluation of a property, they will underestimate the amount of construction. Oh, for a rental grade, you just throw some paint on the wall and throw some carpets on the floor and this place is ready to rent. Yeah, except that, you know, you're going to end up having to replace the heater next year, and the roof is going to start leaking next spring, and you know, the windows, you can't even open them, and you know, these are expenses that if you don't acknowledge them and budget for them up front, they can kill a cash flow investment. So a cash flow investments, you should anticipate seeing between 15 and 25% cash on cash return. What's that mean? Well, if you're paying cash for the purchase and the construction on the property, you ought to be able to get all of your initial investment back between 4 and 8 years. That's pretty good. But there's a reason for that, and that's on paper. I got a little star here that we got to look at. Cash flow investments are typically in not so great areas. You can anticipate having, you know, higher vacancy rates, more turnover. You're gonna maybe replace a tenant every 18 months instead of every 3 or 4 years. So you're gonna have higher vacancy rate. You're also gonna have higher maintenance costs. I don't know why, but lower income tenants typically cost more money. They break things, you gotta go fix it. They're less responsible. And this is, you know, this is a blanket statement. There are always exceptions, but this is what I found in my experience. And then you're gonna have higher turnover costs because the property is not maintained by the tenant as well as, you know, in a more affluent area, because frankly, the tenant is more worried about putting food on the table than making sure that they, you know, update a coat of paint on the apartment every year. Because of that, when it's time to put a new tenant in and going in and doing the fix-up and repairs that are necessary to get the property ready, it's going to be more expensive. So you have to budget a good amount of money, a good buffer there. So you might want to start with a 25% cash-on-cash return in your evaluation and know that with the increased costs, it might end up being 15%. So your total investment, this is my percentage, this is my evaluation. If I go into a property and I find that the rent rate is going to be $1,000, I'm willing to invest up to 50 times that monthly rent rate. So in this example, you got $1,000 a month rent times 50, $50,000 is my total investment. So if I have $20,000 in repairs, my offer on the property is going to be $30,000. So that's for a cash flow investment. On the flip side, let's take a look at wealth building. A property that would fit the template of a wealth building property is going to be located in an area that is 90% or less, or I'm sorry, 90% or more owner occupied, or it's predominantly rented to young professionals or higher end net worth individuals. We're talking about you know, downtown areas and cities. We're talking about established neighborhoods where, you know, it's 99% owner occupied homes, and usually the only renters or the only rental properties in those areas, they're typically houses where the owner couldn't sell, and so they had to move, and so they put somebody in there. But those are the kind of areas that are great for wealth building, because you get a much stronger applicant. I mean, let's face it, I have a property that my wife and I bought and it was our first home. I now have it as a rental property. It's in a nice area, and if I take an application on this property, I won't even consider something if someone that doesn't have a 700 plus credit score. Well, on my cash flow investments, if I required a 600 credit score, I probably wouldn't have one applicant that qualified. So, you know, you're getting a different applicant here. They're going to take a little bit better care of your property. They're also, you know, the area is going to be more well maintained. And this is a big one. This is how you can identify if this is the type of wealth building area that you want to invest in. Property values are much more consistent. We're talking about, instead of having, you know, this huge range of completely renovated properties to properties that are in disrepair of, you know, hundreds of thousands of dollars, we're talking about the handyman special being, you know, selling for $20,000 less than the property that is just immaculate. And the reason for that is people want to live in these neighborhoods. They're willing to, you know, buy a house and put in sweat equity to fix up that handyman special, because they're building their family there. They're you know, they're growing their family. They're raising their family there. When I'm evaluating these type of properties, it's much different than I'm looking at this on a cash flow end. This is almost exclusively based on appreciation and equity. Now, I'm showing you the two polar opposites, and we'll get into kind of a hybrid here in a minute. But the evaluation, I like to call this piggy bank investing. You have a full-time job, you like your job, you're making plenty of money, and you have some money that you want to invest somewhere and you're not sure where you want to put it. Well, if you buy one of these piggy banks, you're going to be able to put a family or a young professional into these properties. They're going to take care of the property. If something breaks, they have the money to fix it. If it's their, you know, if you don't require it, great, but if you require them to fix it, they're going to have the money to pay for it. They're people that are conscientious, and they're going to stay in the property if it's well maintained. They're going to stay there for years and years and years. So it's going to require very little amount of time. You're going to be dealing with professionals, and it's the kind of thing that we're going to base our evaluation on, you know, historic appreciation of the property over time. You know, what was the property worth 10 years ago? Probably significantly less. So we can anticipate that 10 years from now, we're going to have some major appreciation there. Plus, our mortgage is going to be paid down by our tenant. The vacancy rate for these properties is going to be significantly lower than cash flow investments. And your maintenance and repair costs are going to be lower as well. However, one thing that you are going to want to look at is you're going to have to be responsible for updates. So if you are, because these markets are, a little higher end, you're going to be getting more rent for your property, but it's likely you're going to have to pay more for it. And you're going to have to provide more resources for your tenants. In doing my calculations, I'm just worried about covering my expenses. And in some cases, I'm okay contributing a little bit each month. I mentioned earlier that my wife and I have a property that falls into this category. Well, this property, it costs us $200 a month. Now, certainly there's a cap on the number of investments like that I can do, but for one property, I'm investing $200 in the property every month, and I'm getting $800 a month in equity in the property. So every month, I'm getting 4 times, what I'm putting in. This piggy bank is growing very quickly, and that's what I'm looking at more so than anything else. So with a wealth building investment, my target is to cover my expenses. Income minus expenses equals 0 or plus. You just have to have a realistic look at what your expenses are going to be. And this is, again, the place where most investors aren't realistic. What are some of the expenses that you can expect? Obviously, you got your mortgage, taxes, insurance, maintenance costs, utilities, any upgrades that you anticipate doing over the life of the property, any upkeep that needs to be done. If twice a year, you go and you do a clean out of the lawn, right before it gets cold and right when it gets warm, that you got to anticipate. You got to budget for it. And then you want to have contingencies because things happen. Hot water heaters bust. You know what I mean? There's things that have leaks in the bathroom, things that are going to come up that you have to make sure that you have funds set aside so that it doesn't rock the boat and break the bank. My ideal investment is our third option here. And this is kind of a hybrid. I look at cash flow investments as my target when it comes to buy and hold properties. I like income coming in. Income generation is fantastic. But what's really great is when you have income generation and you have awesome appreciation. And that's what I look for. And the ideal hybrid that I'm looking for is I'm trying to target areas where you have less than 30% tenant occupied areas. There's still a good percentage of tenant occupied properties, but it's only about 30%. And what I'm really looking for is for a trend where an area is becoming more and more and more owner occupied. What's that mean? You're getting regentrification. You're getting gentrification in an area that at one time was, more of a tenant occupied property, but you have people that see it and they say, hey, this is attractive. I want to buy in here. I want to buy properties. I want to fix them up, live here, build a family, build a life here. And so what that happens is that, those are the signs of gentrification. And when I'm looking at the property values, I want to see a trend of values trending upward. So, you're probably going to have scattered values all over the place. But if you look at those fixed up properties, maybe over the last 6 months, 12 months, 24 months, you see them slowly rising and rising and rising because more and more people are moving into that area. So how do I evaluate? First, I'm using our rental income evaluation. Right now, in today's market, this area might not be the best area, but I can see that it's moving towards a good area. But today, I still got to pay the bills. I still want this to be an excellent investment. So I'm going to evaluate it like a rental income. And then I'm looking at the appreciation as a bonus. I'm saying, okay, if I look down the road 10 years from now, if there's no appreciation, this is still going to be a pretty decent investment. But there's a pretty good chance that this is going to be one of the best investments I can make because the property value is going to go up 200% in that short period of time. So I'm going to look at this as a hybrid cash flow and piggyback investment. And what's that look like to me? Instead of the really strict 50 times the rent, I'm going to push that a little bit and I'm going to be at 75 times the rent. So instead of paying $50,000 for that property, I'm willing to pay a little bit more and be at $75,000. That's my all-in number. Again, that includes construction, any upkeep, but to bring that property to that 10-year, no major expense level. So, investing in buy and hold properties, it can be one of the most rewarding and most successful parts of real estate investing. It's really where people build wealth. You talk about some of the biggest landowners and most wealthy people in the world. They invest in real estate as a wealth tool, and it's something that you can do as well. But as you take a look at your investments, you also have to look and say, okay, what are my objectives? I can't continually throw money into an investment that's never going to pay me back. Ideally, you'd like to have a hybrid between a cash flow investment and a wealth building tool. That's it for today's real estate training. I wish you the best of luck in your real estate investing, and we'll see you at the next training.